By the end of this video, you'll know exactly how to start investing, even if you only have $50 or more or less. Before we start, please hit subscribe and turn on notifications. I'll break this video down into 5 simple parts: investing philosophy and basics, the power of compound interest, what are ETFs and stocks, how to start investing, and final recommendations. As an artist, I used to think investing was only for people in suits and ties, but the truth is investing is for everyone, especially creatives with unpredictable income. I'm going to do my best to simplify and share what I've learned so that you can focus on what you actually love: painting, sculpting, writing, filming, designing, running your business. Investing is the key to financial growth and stability. At its core, investing means putting your money to work so that it grows over time. The biggest misconception people have is that saving money alone is enough. But here's the problem. Money sitting in a traditional savings account loses value every year due to inflation. A savings account might feel safe, but it's actually a slow leak. If you save $10,000 today and inflation is 3% per year, in 30 years, that same $10,000 will only have the buying power of about $4,120. In contrast, if you invest that same $10,000 in something that grows at an average of 8% per year, it could turn into $100,000 over the same time period. Not investing is riskier than investing, which brings us to one of the most powerful concepts in wealth building: compound interest. If you take away just one thing from this video, let it be this: compound interest. Albert Einstein called compound interest the 8th wonder of the world, and for good reason. It's how small amounts of money grow into massive sums over time. What is compound interest, Keish? Well, it's when your money earns returns and then those returns start earning returns. It's like a snowball rolling down a hill, growing bigger and faster as it goes. Honestly, it's like the magic of investing. It's almost too good to be true. Example, let's say you invest $100 a month at an 8% annual return. What's a return? A return is the percentage of profit your investment earns annually. So in this case, 8% means for every $100 you invest, you gain $8 in profit over a year. Okay? So back to the example. If you invest $100 per month at an 8% annual return, in 30 years, you will have approximately $150,000. Out of that, you only contributed $36,000, and the rest comes from compound interest growth. Let's take it even further. What if you invest $1,000 per month at the same 8% return? In 30 years, you will have over $1.8 million. The earlier you start, the more dramatic the results. Time is your best friend when it comes to investing. So now that you understand why investing is so powerful, let's talk about what you can actually invest in. ETFs and stocks. When you buy a stock, you own a piece of one company. Companies like Amazon, Apple, Tesla, etc. Think of it like owning a single tool, your favorite paintbrush. If the company does well, your stock increases in value. If it doesn't do well, you lose value. On the other hand, ETFs, exchange traded funds, are like a toolbox. They bundle multiple stocks together, giving you instant diversification. Why does this matter? It matters because ETFs spread risk across multiple companies. So if one stock underperforms, it's not doing so well, other stocks in the ETF can balance it out. But with a single stock, you take all the risk. Side note, to check if a stock is underperforming, you Google its ticker, like AAPL stock is the ticker for Apple. You look at the chart, compare it to the market. If it's dropping while the S&P 500 is rising, it might be struggling. The S&P 500 is a list of the 500 biggest companies in the US, showing how the stock market is doing overall. Quick sites like Google Finance or Yahoo Finance make it super easy. The key differences between ETFs and stocks, so you can decide what works best for you. ETFs are less risky because they're diversified. Stocks are riskier since their performance depends on just one company. With stocks, you have complete control over what companies you invest in. ETFs offer pre-selected groups, which can save you time. Stocks have the potential for higher returns, higher risk, higher reward, but ETFs offer consistent, steady growth over time. If you're new to investing, I recommend starting with ETFs. They're like training wheels, and as you gain confidence, you can add stocks to your portfolio. So how do you actually start? Here's a simple step-by-step beginner-friendly guide. Step 1, open an account, either a brokerage account or a retirement account. Brokerage and retirement accounts are not the only options, but they are the most common for investing. Think of your account as a shopping cart. It's where you hold your investments. It's not the investment itself. Open a brokerage or retirement account on platforms like Vanguard, Robinhood, or Wealthsimple if you are in the beautiful country, not 51st state of Canada. These are all great options, especially for beginners. Key difference: retirement accounts offer tax benefits, but have rules on withdrawals. Brokerage accounts, no tax advantages, but they offer more flexibility for buying and selling investments at any time. You can open both if you want. Step 2, set a budget. Even $50 a month can grow into something significant. The key is consistency. Step 3, choose between ETFs and stocks. I would start with ETFs for simplicity and then add stocks as you learn more. Step 4, set up automatic investments. This strategy, called dollar cost averaging, helps you invest consistently without overthinking. Step 5, track your progress to monitor your growth. It's like tracking your art portfolio. It's super motivating and fun. If you'd like, I made a guide that breaks down all the different types of accounts you can choose from, just to have a better understanding and awareness of the options out there. Maybe go over it with an actual financial advisor, because I am not one. I'm just sharing information that was given to me by actual professionals. Part 5. Final recommendation. So I'm not telling you what to do. I'm just sharing what I personally do that's been working well for me. I have both a brokerage account and retirement account. A list of ETFs I invest in are as follows. I also invest in crypto, which is a whole other video, but the ones I believe in are Bitcoin, Ripple, Ethereum, Dogecoin, and Solana. It's written. Crypto is a lot more risky. I gradually increase the monthly contribution whenever I can. It comes out of my account automatically, so I don't even have to think about it. All I gotta worry about is groceries. Spending $20 on a cauliflower. Grocery prices are ridiculous. Tips for managing risk. Start with ETFs. They're safer and easier to manage if you're new. Don't invest money you'll need soon. Only use money you don't need for at least 5 years. And try to build an emergency fund. Have 3 to 6 months of living expenses saved before you invest heavily. Final reminder, every dollar you invest is a gift to your future self. Imagine a life where you can create freely because your money is working for you in the background. The best time to start investing was yesterday. The second best time to start is today. Don't wait for the perfect moment. Just start small and stay consistent. If this video helped you, please hit like and subscribe. You can grab my free guide, Investing for Beginners. It's in the description. Thank you so much for watching, and I will talk to you later. Bye.